Futures right now, as you can see, mixed with the NASDAQ on the Google News sharply higher, S&P up a little as well. Join us now, Alicia Levine, Head of Investment Strategy and Equities at BNY. No, wait a minute. It's BNY, but it's BMO. BMO, you pronounce BMO, right?
But we're BNY.
But you're not BNY. Okay.
We are BNY.
You're BNY. Okay, I was just briefly was concerned. I wasn't, actually. So, Alicia, you've been really confident, I think, about the market's potential to ignore a lot of extraneous things and continue to move higher. But you're very good at mentioning why it shouldn't be. And just quickly, you say, tough September trading, tariffs, rising yields, Fed drama, jobs data. There's a lot to worry about. You still think we go higher because of one thing, earnings.
Earnings.
Yeah.
So it's really an earnings-driven market. We raised our earnings expectations for this year and next year, and with it, our S&P target for the end of this year and next year as well. And I think what you're seeing, and you started the conversation this morning and somewhat yesterday as well about with the disconnect a little bit between
chaos.
The market,
Yeah.
economy, and the real economy, and the bifurcation in the consumer. And what's happening really is that corporates are able to produce earnings, produce margins. At the same time, while some of the macro data is less than stellar, some concern over what's happening with the labor market. The bifurcation in the market economy and the real economy is notable, but ultimately the market is focused on earnings and margins and free cash flow, and we are going up and to the right. And so therefore, we think the market can drown out the noise, even though there is a lot of volatility in the policy choices.
Right, that's where the rubber meets the road. These two numbers, 2025, I don't know where people were for earnings growth for 2025, but you say it's 11.5% at this point, which is higher than anyone thought. And then what's going to happen next year? What about tariffs? What about the Fed? 13.4% earnings growth in 2026.
That's right.
So if you knew that, and if we could say for sure that you were right, you really could ignore a lot of the noise, I think, because that's the one thing you'd like to know, what corporations, how they can grow.
I mean, that's how the market trades, right? The market trades on the fundamentals of the corporate sector, and so that's what we're focused on. The noise is noisy, right? So it's very easy to get distracted about sideline conversations, but I think about this as, we have to stick to our first principles. What do we know to be a fact? And what we know is that earnings create the momentum in markets. And if you're beating earnings to the extent you did in the first quarter and the second quarter, and I suspect in the third quarter as well, then you're in a place where the Fed is cutting into an increased earnings cycle, which will be bullish for markets, even though there are concerns all over the place on policy choices.
Alicia, I love that. That is so Yogi Berra-like. The noise is noisy, but you got to tune it out. You got to look and see what's around.
And so, our clients also ask us, how come you were able to see through this? How do you do this every day? How do you wake up in the morning when it's all around you? And I say, well, I look where earnings expectations are going. I hear what corporates are telling me. And what we see is that ultimately, let's look at the earnings that came out last week for the retail sector. Much better than expected, because everybody thought the tariffs were going to be very difficult for them, and the consumer is not holding up on the revenue side. And they were fine. They were much better than expected. So I think what you're seeing is a reacceleration. And if you look at the way assets are trading, it's telling you there's a pro-cyclical bent here. So financials are doing great. Industrials are doing great. The equally weighted S&P hit a new high last week. Like all these things that have sort of been dead, taken over by the Mag 7, the assets are now broadening out. It's telling you that the economy is muddling through better than expected.
I've watched the market and argued that, look, the market is telling us that things are going to be okay. But then I always think, the markets might be wrong. They've been wrong a lot. And I thought yesterday when we were down over 500 points, I was like, okay, some of the roosters are coming home. I don't know, the chickens are coming, but they don't roost because they're chickens. But it almost looked like things were coming to roost. Yeah, and any day we worry, any day we feel like it could happen. If something goes over 5%, the 30-year or the 10-year goes back to 4. We always think something's right. But if you knew that the markets move was based on the fundamental reason, and that is that we're seeing better than expected EPS growth, then you wouldn't have to just say, well, the market's telling us something. Nebulous.
It's good that we're all kept to our knitting, right? It's good that there are concerns. Investor sentiment is not that high. In fact, it's pretty bearish. It's the most hated bull market, but we think we're in it. I think that the earnings will keep it going. The one risk here, the real risk, and you know, I sent you the notes here, the risk is that the margin growth and the free cash flow that have allowed the market to be in a higher multiple regime.
Right, from tariffs could go down, right?
That's the risk here. The risk is that the margins start getting clipped from the tariffs, and at the Mag 7, they're spending so much that the free cash flow ultimately over 2 years goes lower. That's your risk to the market.
Okay. So, but as a result, 6,400 holds. By the end of the year, you're 67 possibly, and then for next year, what, 7,400 by the end of 2026.
That's we do.
And
a
that's not
range.
even, that wouldn't be that much of a gain next year.
No, I mean the numbers are getting big, right? And then when you think about where earnings are going, if you're growing off a base, we did this in mid to late August. That means by the end of 2026, the increase is quite.
That'd be 10% though next year. Anyone would sell
right,
over 10.
Which is not unreasonable.
No, and good.
The Fed is cutting into increased earnings cycle, with assets telling you there's a cyclical growth upswing. That is the thing to remember. That is the key thing. Can bond yields globally, jolt the markets? Of course it can. You can easily have a 5 to 10% sell-off. That's normal. But if you're playing the long game, and we play the long game, we're focused on earnings and we're focused on the direction.